Now I want to bring in Matthew Johnson, president at Johnson Wealth and Income Management, to discuss all of this market action. Matthew, welcome. Thanks so much for joining us. What's your reaction to how the markets have opened this morning?
Well, hey, thank you for having me, Chloe. It's good to be on the program. It's not very surprising to me, when we have a very dovish, very benign, very kind of blasé report, and they say we're going to be raising interest rates by 0.25%. But then all of a sudden we have 517,000 jobs that are added. This is what's giving all of the heartburn to the Federal Reserve. They want to be able to see contraction within the economy. We're starting to see the inflation coming down, so that's a good thing. But I think what we're going to be anticipating is that they're going to keep these interest rates hiking for a while longer as a result of that. Many moons ago, back in 2022, we know that Jerome Powell had suggested seeing unemployment above 4%. And now we're sitting at 3.4, the lowest we have seen in absolute decades. So what this means is more of the same. They've raised interest rates, and they're going to keep raising interest rates because they want to continue to bring that contraction into the economy, and they want to be able to see that higher unemployment level.
Before we saw this jobs report, we had some experts anticipating that we could see a pause in rate hikes as early as March. Obviously, now we have this highly anticipated speech from Fed Chair Jerome Powell later this afternoon at the Economic Club of Washington. It'll be the first time that we're hearing from him since that rate hike, since that jobs report. So what are you anticipating actually hearing from him?
Well, I believe that he's going to come out and he's going to say, listen, we're very data driven. We're very data dependent. It's great that inflation is coming down. So it means that what we're doing is actually working, which is a great sign. It is a great sign to see that they have reduced the tenor or the speed in which they are doing these rate increases. The size of the rate increase coming down is a great sign. But we have to be anticipatory that there's going to definitely be more of the same. When we look at how they've raised these interest rates, they started out with 0.25%. They went to 50 basis points. They did 75 basis points 4 different times. Then they've just started to peel off the curve, and now they're coming back down again. But I do anticipate that instead of having maybe a rate cut or just a rate halt altogether, we're going to be looking at more rate increases, I'm guessing, until probably May, maybe even June now as a result of this. I don't think we're going to be seeing them go from 25 to 50. I think that would be overreacting, and that's really going to take things by a knee-jerk reaction if they go ahead and they do that. But it is going to be a longer duration now as a result of the jobs growth.
Now, we're in the midst of earnings season, Matthew, and it's really shed some light on the state of the economy here. We've seen mixed results from major companies, also a streak of layoffs in the tech sector. What do you make of the earnings season so far, especially in tech, and what does it say about the economy moving forward?
Well, I think that we really got very overheated after 2020. We kind of anticipated, with all of the liquidity that was within the market, the low interest rates, and the borrowing power that many of these corporations had, they got really excited. And you know what? We would probably be excited as well if we were them. But now they're anticipating and they're seeing what's actually going to be the implication of these higher interest rates for a longer period of time, and they're going to have to do something. That's the reason that we're seeing the layoffs that we're seeing. So I anticipate that for 2023, it's going to be more mild earnings. I'm not seeing a lot in the form of strong profits. Now, there could be a couple of exceptions to the rule. But I think either A, the average investor has to be ready for just some mediocre at best growth within the various different companies that they're investing in, or they can make a small shift and begin to focus on the dividends and the interest that are to be had within the marketplace. There is plenty of good quality companies right now that are still free cash flowing, that are paying good dividends, which I think are on sale. And they're going to continue to be on sale. And if we have dividends that are being paid to us, it allows us to be able to dollar cost average and add shares to our portfolio. But we also cannot forget the fixed income market. The fixed income market, when you can pick up government bonds that are paying, over 4.4%, you can pick up corporate treasury, corporate bonds right now paying 6%. It's a pretty sweet deal.
All right, Matthew Johnson, thank you so much for that time and for your insight this morning. Matthew Johnson, president at Johnson Wealth and Income Management.